64 AD. Rome is burning. Wish you there, and mind you, Rome didn't fall because it lost a war it couldn't win. Nero stands over the ashes of a city that funded an empire, and he has a problem money can't fix, except it can. Not the money he has, the money he's about to invent. The treasury was literally empty. The legions still need paying. The city still needs rebuilding. And Nero, the most powerful man on earth, does not raise a single taxes. He does something quieter, something almost boring. He orders the mint to change the recipe. The denarius, the coin that built Rome's credibility across 3 continents, goes from 100% silver to roughly 90%. Same size, same stamp, same face. 10% of its substance simply gone. No Senate vote, no public announcement, no riot in the forum. Because here's the thing about theft: when you own the mint, you don't need to take something from someone's hand. You just need to change what's already in it. This is the first recorded instance of a technique that would outlive Rome by 2,000 years. And we're going to spend the next 14 minutes proving that the United States government has been running Nero's playbook, just with better technology. Welcome to Capital Historian, where power, wealth, and history converge. To understand why Nero reached for the mint instead of the tax collector, you have to understand what kind of empire Rome had become by the time he inherited it. Stay with me. Do you know for 200 years, Rome's economic engine was conquest. New territory meant new silver mines, new slaves, new tribute, new grain. Expansion wasn't a policy. It was the business model. But by the mid-1st century, the easy conquests are gone. The borders are stabilizing. The mines that fueled the Republic are being worked out. Meanwhile, the cost of running an empire this size is only going one direction: up. A professional standing army needs to be paid whether it's fighting or not. A capital city of 1 million people needs to be fed whether the harvest is good or not. And an emperor who wants to stay emperor needs bread. Circuses and monuments, the ancient equivalent of approval ratings. So Rome hits a wall. Every mature power eventually hits. Expenses that grow automatically colliding with revenue that doesn't grow automatically anymore. Taxation could, in theory, close that gap, but taxation is visible. Taxation has a face. Provinces revolt over taxation. Senators lose their fortunes to taxation, and senators had knives. Nero needed a lever that didn't announce itself. And it turns out, an empire that controls its own currency always has won. The question is, what exactly did that lever let him do? And why has every government that's discovered it since found it almost impossible to put back down? Here's the structural trick, stripped of a Latin. Whoever controls, the mint controls the definition of value. Not the value itself, the definition of it. And once you control the definition, you control something more powerful than gold. You control what everyone else believes gold is worth. Think of it like this. Imagine the entire Roman economy is a shared language, and the denarius is a word everyone agrees means this much silver guaranteed. Nero didn't ban the word. He just quietly redefined it, while making sure it still sounded, looked, and spent exactly the same. That's the mechanism. Debase the substance, preserve the symbol. And the payoff for the state is almost obscene in its efficiency. With the same stockpile of silver, the mint could now strike more coins than before. 90% silver stretched across more currency meant Nero could pay his legions, his contractors, his architects, with money that was, quite literally, worth less than what it claimed to be. This is the part most people miss. Debasement isn't theft from the treasury. It's theft through the treasury, extracted invisibly from every single person holding the coin, distributed one imperceptible percentage point at a time. A tax has a target. Debasement has none. It doesn't take from the rich or the poor specifically. It takes from anyone who trusted the coin, which in a functioning economy is everyone. This is the core conflict every currency issuing power eventually faces. The state's short-term need for liquidity against the population's long-term need for a stable store of value. And because the state holds the mint, that conflict is never a fair fight. It's rigged from the design phase. The only real question left is, How long can you keep pulling that lever before people notice the coin isn't what it says it is? Rome was about to find out. Nero's 90% silver denarius doesn't collapse Rome. That's the trap of debasement. The first cut never does. It's small enough to be absorbed, subtle enough to be denied, and successful enough to be repeated. And repeated it was. Trajan does it. Marcus Aurelius does it, financing wars on two fronts. Septimius Severus does it, needing to buy the loyalty of legions who just made him emperor by force. Each one tells himself the same story Nero told himself. This is temporary, this is necessary, this is different. It never is. By the reign of Gallienus in the 260s AD, roughly 200 years after Nero's first cut, the denarius is no longer a silver coin. It's a bronze coin with a silver wash, containing perhaps 5% actual silver. It looks like money. It is functionally a rumor of money. And here's the part the history books underplay. The fall wasn't sudden. It was a slow-motion trust collapse. Merchants stop counting coins and start weighing them because the number stamped on the face has become meaningless. Soldiers, the one group an emperor absolutely cannot afford to alienate, start refusing payment in currency. Altogether, they demand grain, land, goods they can actually use. The empire that once ran on a single unifying currency starts fragmenting into a patchwork of local, barter-based economies before a single barbarian army crosses the Rhine. This is the mechanism's real damage, not inflation as a number on a ledger, inflation as a solvent, quietly dissolving the invisible trust infrastructure that let a sprawling empire of dozens of cultures function as one economic organism. Rome didn't fall because it lost a war it couldn't win. Rome fell into a currency it could no longer trust. And by the time that was obvious, the coin wasn't the only thing hollowed out. Which raises an uncomfortable question for anyone holding currency issued by a government with unlimited authority to redefine it. Has this actually stopped happening, or did it just change its name? August 15th, 1971. Richard Nixon appears on television on a Sunday night, deliberately timed to avoid market panic, and announces that the United States will no longer convert dollars into gold. Watch the structure of that decision, because it's Nero's mint run through a television studio instead of a furnace. The dollar's backing, its silver content, so to speak, is removed. The face value stays exactly the same. The bill in your pocket looks identical the next morning. No vote, no referendum. A technical announcement absorbed by a public that mostly didn't understand what had just changed because nothing visible had changed. That's the pattern completing itself 17 centuries later. And the tool has only gotten more efficient. Rome needed a furnace and a mint master to debase its currency. The modern version doesn't require shaving a single coin. A central bank can expand the money supply with a keystroke. Quantitative easing, deficit monetization, emergency lending facilities activated in a weekend. The lever used to be physical. Now it's a balance sheet entry. The mechanism, though, is identical. Fund obligations you can't or won't raise taxes to cover, using a method most of the population can't see, price, or vote on in real time. And just like Rome, the pressure driving it is structural, not personal. No single president or central banker chose this the way Nero chose his mint ratio. It's the same bind, a state whose obligations, entitlements, debt service, military commitments spanning the globe grow on autopilot, colliding with a political system that treats raising taxes as career suicide. When those two forces meet, debasement isn't a temptation. It's the only lever left standing. Now, look at who's already weighing the coin. Central banks, not individual investors, central banks have been accumulating gold at a pace not seen in decades. Sovereign wealth funds are diversifying reserves away from dollar-denominated assets. This isn't paranoia. It's the modern equivalent of a Roman merchant reaching for a scale instead of trusting the stamp. The institutions closest to the mechanism are the ones hedging against it first, which tells you something about what they expect to happen to everyone still trusting the face value. None of this means collapse is imminent. Rome's debasement played out over 2 centuries, not 2 years. But the trajectory, the direction of the mechanism, is not a matter of opinion. It's a matter of definition. And once you understand a definition, you start noticing it isn't hidden at all. It's printed in plain sight, in every dollar that says backed by nothing without ever having to say it. So the question isn't whether the dollar is following the denarius. The question is whether. You'll recognize the moment it stops being deniable, before or after everyone else does. Here's the through line that connects a Roman furnace to a Federal Reserve balance sheet. Currency was never just a medium of exchange. It's a technology, a piece of infrastructure built to maintain trust across a population too large, too spread out, too diverse to govern by force alone. Whoever controls the definition of that currency controls something armies can't buy: obedience without a soldier in sight. Rome discovered this almost by accident, in a burned-out city with an empty treasury. It didn't die with the empire. It got formalized, refined, rebuilt into central banking, monetary policy, and a quiet authority to redefine what a dollar, a euro, or a yen actually means, one policy decision at a time. The denarius didn't fail because barbarians broke down the gates. It failed one imperceptible percentage point at a time, until the people holding it simply stopped believing it meant what it said. So here's the only question that actually matters when the dollar reaches that same threshold. Not if, when. Will you recognize it while there's still time to do something about it? Or will you be the merchant, reaching for a scale only after everyone around you already has?